The TSX today just won't stop, hitting an intraday high, as mentioned, above 30,600, now at 622. But is now the time for investors to look towards bonds to protect against any potential downturn? Let's go to Rose Devli. She's a portfolio manager with Dynamic Funds. Thanks for joining us today.
Thanks for having me.
So through the stock market surge, what's been happening in the bond markets?
Yes, bond markets, and depending on what geography you're talking about, let's talk about the U.S., for example. Since the beginning of the year, we have had actually lower yields, which is surprising because everyone's talking about inflation, everyone's talking about at equity highs, but people don't realize that actually bond markets have rallied from those January and April highs, depending on where you are on the yield curve. For example, we saw highs in the U.S. 30 years basically after Liberation Day, when VIX was hitting 50, 60, and everyone thought that long bonds were going to 7, 8, 9%. We saw that kind of tipping off at the 515. Now it's down to around that 475 area, which seems a little bit sticky here. In Canada, we have seen a little bit of volatility in Canadian rates. We entered the year actually at a little bit lower rates than we are at today. We have seen Canadian yields kind of oscillate around this area. We have a lot of unknowns given tariffs, given trade wars with the U.S. So that is something that we're monitoring, especially heading into perhaps policy fiscal stimulus in that November date that Carney has held. But right now, we think that there is still value in the bond market, especially when you take when you see what's happening in the U.S. A lot of our dynamic active ETFs, especially DXB, has taken advantage of U.S. yields being so high. So we're expecting kind of here or a little bit lower heading into the end of the year.
Okay, so let's talk about the U.S. government shutdown, which is carrying on. There's concern, as you mentioned, with data being delayed coming out of Washington, obviously. How is the market interpreting all of this?
That's a big question mark that everyone talks about every day. I mean, it's really at a standstill in terms of where we are pulling our data from now because we aren't getting it from official agencies. There are some private data sources, but they aren't as great as what we see from the BLS. But there are some things that are giving us flags how long this shutdown will be. For example, October 15th is when military should be getting paid. We need to see that shutdown hopefully ending around there, although we do think here at Dynamic that it could be a longer shutdown heading into November. So what are we going to do there? Well, we're going to have to extract the data from where we can, from alternative sources, as well as on the private side to get our next glimpse.
Just wondering why you think that the shutdown could last even longer. What are you looking at?
Well, we're looking at kind of where the Democrats are versus the Republicans, to be honest. It just seems like what's motivating both sides are at different areas. And to get to that kind of agreement probably will take some time and take some measure. It looks like a lot of voices are feet stuck in the mud right now. I mean, anything can turn on a dime, but we're expecting, what we're expecting versus what could happen is kind of as a bond investor, our worst case is where this shutdown can be a prolonged one versus other shutdowns that were very short.
You're also looking at cracks emerging in consumer credit. What have you noticed?
Yes, we are at this point think it's more idiosyncratic in the private credit side. So what has happened there, kind of what's coming out in Tricolor and First Brands and the smaller mid-tier auto sectors is making us having a little bit of spidey sense come up and thinking, we should be monitoring this. But at this time, we're thinking it's idiosyncratic. It's kind of those loans that are at the lowest end of the credit spectrum. So the triple C's of the world, they don't do well. The loan market doesn't do well when you have interest rates coming down. We had those loans kind of agreed at very tight spreads. So it's not really a great environment for private credit right now. Again, there's a stronger, dealers and deals out there that are fine, but it's that lower tier that we have question marks about.
Okay, right, let's talk about rate cuts as well. Just want to get your outlook on rate cuts. What do you think?
Sure, we do think that the Fed will cut at the next meeting. Now, a lot has been priced into the market, obviously, heading into 2026, 4 to 5 more cuts. Will that play out? We do see a scenario where at least we see, so it's around 425-ish Fed funds. We could see kind of that 350-ish easily. Obviously, the market is pricing in more down to 3%. We definitely need to see more cracks in the labor market to get there. But, it could easily get there. The labor market, it can rent. When labor markets roll over, they typically roll over in non-linear fashion. So something to keep, and that's why it's so important to pull data sources where they can, even if it's from the private sector or alternative, because this is the number one area that we should be focusing on right now.
Yeah, that's what the Fed has been looking at as well. So when it comes to bond yields, are you saying lock in to longer yields? If so, how long?
Sure. I mean, I wouldn't necessarily run the long, and we told our clients that we would be buying kind of that 550 area in longs. Right now, with that large rally that we've seen since those highs, we still think this kind of 7 to 10 year part of the curve in the U.S. makes some sense to us. I just want to reiterate, higher yields aren't necessarily bad for a bond portfolio. When you see higher yields, albeit it's all timing, higher yields brings your maturities higher investment. So as a bond manager, I don't necessarily want to see yields collapse. This running yield that we have right now of around 4 or 5, depending where you are on the curve, is great. If you see U.S. aggregate year to date numbers over 6% on a risk adjusted basis, that's historically an excellent return. So I wouldn't say, with the late cycle exuberance that we might be seeing in the equity market, if you don't have bonds in your portfolio, now is probably a time to put some on. All
right, Rose Devli, got to leave it there. Appreciate your time. Rose is portfolio manager with Dynamic Fund.